Okay, hi everyone. This is going to be the summary lecture for chapter 1. We're going to be looking at the first half of the PowerPoint here. So, what are we looking at in this chapter? Why do we care about tax? How do you define a tax? The different types of taxes, the different types of taxpayers, how you would evaluate a tax system. So, as a starting point, why do we care about tax? Well, hey, it's really important in society. How you fund, like the roads, the schools, the police, right? These all come from taxes. And really, there's like three important areas it comes into play and why we care about it. So, personal finance, right? Your 1040, planning for retirement, estate and gift tax, right? In your own life, you're going to care about, and taxes are going to matter. Likewise, business decisions. Hey, you want to form a business? What type of entity should it be? What are the tax consequences of this? And then, of course, right, you're going to see taxes in the political sphere. So in this framework, Democrats are generally going to favor more taxes, and Republicans are going to favor less taxes. So we keep talking about taxes, right? What does this mean? Well, the formal definition of a tax, it's going to have three elements. One, a payment that's required. Two, by a government. Three, that is unrelated to any specific benefit or service that's received from the government. So let's look at a couple examples here. First one, right? We have a taxpayer. They travel to Alabama. They rent a hotel room, and hey, there's a 2% surcharge on that room. And what those funds are used are for the general highway. Is this a tax? Well, here all three elements are met. That is to say, it's a payment required by a government. And in this case, because it's a general highway, right? Like everybody can use it. It's not going to be specific to the taxpayer. Let's distinguish that from example 1-2, right? Say we have two taxpayers, they're building a house, and in doing this, right, they have to pay $1,000 to the local government to connect a sewer system. Well, in this way, right, we meet the first two elements. We have a payment that's required by a government. However, we do not meet the third element. In other words, we're receiving a specific benefit here. We're getting, the sewer line just for us. It's not for like everybody. Right? Likewise, things you need to be aware of. Fines, fees, penalties. These are not taxes, right? So you get a speeding ticket, that's not a tax. Continuing. So we said here, right, when you're talking about taxes, the general formula to figure out what you owe is going to be basically the tax base times the tax rate, gives you your tax liability. So the liability, again, what you owe. The tax base is the substantive item being taxed. It's usually a dollar amount. And then the tax rate is going to be like the level of tax. And this is normally going to be a percentage. So, hey, a simple example, right? You go in the dollar store, you spend $7. There's a 5% tax rate. Hey, you owe 35 cents in tax, right? So you can see the example down there. Now, one of the things you got to be aware of, right, is that while this is a simple formula, when we look at the individual income tax, which is going to be a big part of this chapter, the tax base, right, this is going to be broken out kind of into buckets, right? It's going to be a progressive tax system. And what I mean by that is like the first bucket, for example, maybe your first 10 grand of income is going to be subject to 0% tax. From 10 grand to 25 grand, maybe it's 10% tax, right? You have just like bucket, bucket, bucket. And all of those buckets, like the tax rate is going to increase. So essentially how you would do it there is, right, you'd have to basically use this equation in each bucket for the amount of income and then add them all together. What's the shortcut for this? Well, the IRS, they're going to give you different tables you can use that's going to save you some time. We're going to see that in an example here. But let's kind of continue the discussion about taxes, right? So we said, why do we care about taxes? How do we define them? The next thing we're going to do is how do we describe taxes? So we have our marginal tax rate, our average tax rate, and our effective tax rate. The marginal tax rate, like in everyday parlance, that's just going to mean basically, hey, what tax bracket am I in? right? Am I in the 37% tax bracket? If I make, a dollar more, I'm going to pay 37%. That's kind of like when people say my marginal tax rate's 37%. That's true, right? We said that factually that is true. The bucket you're in, the last bucket is going to be your marginal tax rate. However, when somebody says that, right, like I pay 37% on my taxes, that's not really an accurate way of describing it, right? Because all of those previous buckets, hey, maybe you paid 20%, 10%. So that's why we have things here like the average tax rate as well as the effective tax rate. So those are probably better ways of describing what the amount of tax you pay is. And with this, right, we're going to have a formula for each of them. So let's start with the marginal tax rate. So this is going to be the tax rate that applies to the next additional incremental amount of a taxpayer's taxable income. It can cut both ways. In other words, you may have to calculate the marginal tax rate when income increases, or alternatively, if income decreases. The formula here, right, it's going to be the change in the tax liability over the change in the taxable income. So let's look at some examples here. Right, the first thing, right, let's get used to using a table, right, because the IRS, right, they're going to give you kind of a shortcut way to do it. So in this situation, right, we have 160 grand of taxable income. We need to figure out what the tax liability is. We have the simple equation, but we know because this is a progressive tax system, it can be a little bit complicated. So we'll use the table to help us. So first off, the facts indicate their filing status is married filing jointly. We're going to say, hey, we have 160 grand. We go down. Here we go. We're right in here. This is basically how you figure out the tax liability. In other words, it's 10 grand plus 22% of this excess amount, right? So you'll take the 160 minus the 89. Hey, there's the excess. 22% of the excess is 15 grand. So our tax liability will be 10 grand plus the 22% excess. There we go, right? That's the first thing. And you got to be careful when you're using these tables. Hey, am I using the single table? Am I using the married filing jointly? We'll learn about the filing statuses. Second thing, right? We just figured out, we said, hey, you make 160 grand and you're going to owe 25,000 on that. What we just did. Now they're changing up the facts a little bit. They're saying, hey, what if there was an additional $80,000 of income? So you're going from 160 to 240. What is the marginal tax rate on that additional 80,000? Right? Well, the problem here, why you can't just use a single bucket, right? Like, so for example, if you're in the 25% bucket and you make $5 more, 99% of the time that's going to be taxed at the 10% bucket or whatever the one you're in, like it's intra bucket. The problem becomes when you get a big swing like this, because then you're going from one bucket to the next, right? It's pushing you into the next tax bracket. So you're going to have to use the equation. So what do we do here, right? Well, essentially we now are going to have to play the game again, calculate our tax liability. This time we have 240 grand, right? The 160 plus the 80. And when we use the table, right, you would go through, you go down, you'd find the income amount, do the math. Hey, we owe 44,000. In this way, right, we're going to take the change in tax liability, the new minus the old is 18, over the change in taxable income, the new minus the old is 80, 18 over 80. Hey, our marginal tax rate here, if we made $80,000 more, is going to be 23%, right? And again, this is for an upswing in income. 1.5, right, you can look at this. I'm not going to belabor it here. It's basically the same facts, but hey, what happens if our income went down by 90,000? How much and what is our marginal tax rate on those tax savings? So again, like I said, just be aware it could be calculating it when income goes up or when income goes down. All right, let's talk about average tax rate versus effective tax rate, right? So we said you have Mr. Monopoly. Hey, I'm paying 37%. Yes, that's true, Mr. Monopoly, but that may not be your average tax rate. In other words, we need to look and see on average, in light of all of those buckets where you're paying tax, what are you on average paying? So here what you do is you're going to take your total tax liability over your taxable income. So let's look at example 1.6, right? So, hey, it looks like we have, in this case, a taxpayer. They have 160 of taxable income and 10,000 of non-taxable. And it looks like on that 160, they owe 25. So it's just plug and chug, right? Our tax liability is 25. We calculated that from the table before. We had 160 of taxable income. Our average tax rate is 16.13%. Okay. Let's compare that with the effective tax rate. Essentially here, what the change is, right? It's just like the average tax rate, except the denominator, right, is going to be your total income. And what I mean by that is your taxable plus your non-taxable income. So let's look at 1.7, right? So here, right, it says assume we have two taxpayers. They have 160 grand of taxable income and 10 grand of non-taxable income. Same tax liability of 25 grand. Here, right, 25, but it's going to be our total income, the 160 plus the 10. Now, one of the things you got to be aware of for this chapter, and we will look at this, is something called municipal bond interest, right? So municipal bond interest. This is basically a state and local government interest on bonds, right? So a very simple way, right? Hey, we have West Virginia, the state, they want to build a new bridge. How they fund this is through issuing debt, right? You give them $1,000, they pay you $50, $50, $50, you get your $1,000 back. All of those $50 payments, right? That's going to be considered municipal bond interest that is not taxable. And the reason they make this not taxable is for public policy purposes. They want to encourage people to invest in state and local bonds. So we will see in this class, but the big thing for this chapter is just be aware that interest you receive as a taxpayer from state and local bonds, known as muni bond interest, is not taxable. It comes into play whenever we're determining average versus effective tax rate. Specifically, the denominator in our average tax rate will exclude that, where our denominator in our effective tax rate will include it. And in this way, one thing you'll see just from like kind of a hypothetical theory standpoint is the denominator here is always going to be essentially equal to or smaller than the denominator here in the effective tax rate, or in the effective tax rate. So in other words, your effective tax rate from like a theory standpoint is always going to be equal to or less than your average tax rate. So here, right, 16%, the effective tax rate's lower when you start looking at all the income. Okay, continuing here, a flat tax rate versus a graduated tax rate. Well, flat tax rate is whenever a single tax rate is applied to an entire tax base, right? So that dollar store example, if you go in and you buy, $100 worth of stuff, it's going to be 6%. If you buy $1 worth of stuff, it's 6%, right? It's flat tax throughout, right? 6% no matter how much you spend. In distinction, a graduated tax rate, right, this is going to be like the income tax, right, how that's taxed. So here, right, let me see if I can draw on this, right, maybe the first 10 grand of income, you're going to pay 0%. From 10 to 30, right, you're going to pay, 10%. From 30 to 50, you'll pay 12%. These aren't like spot on accurate. I'm just trying to show you it. But the idea here is the tax base, right? You make, 50 grand, right? That represents the tax base. That's like you go in and you spend $50 at the dollar store. This is divided into parts, right? Like that part, that part, that part. And each of them are taxed at different rates. So you have 0, 10, 12. In this way, right, there's a couple other ways we can describe taxes. So it can be proportional, which is kind of like another way of saying a flat tax. It's going to be constant throughout. And then you have progressive versus regressive. tax rates. And progressive is essentially where there's increasing marginal tax rates as the tax base increases. So here, right, we're going from 0 to 10. Oh, it keeps getting bigger, right? The more money you make, right, the more, the next tax bracket is going to be. It's going to be bigger and bigger. In distinction, right, a regressive tax rate is when you go from one bucket to the next and it gets smaller. So, for example, the idea here is self-employment tax, sometimes known as FICA, right? That's what they use to fund Medicare and Social Security. The idea with this is, and it changes from year to year, it's probably something like 160 grand, right? Up until 160 grand of income, you pay 15.3%. Afterwards, right, it's like a cliff. Then you're phased out. It's no longer there. So technically for SE tax, it's regressive in the sense at a certain point it just drops off. The more money you make, the lower the tax rate gets. So let's look at example 1.9. Oops. All right, so this is just giving us some facts here. It says we have 3 taxpayers, right? They're showing their total income. So this guy has 75, 170, 300. So each one, right, the income's going up. And when you run the numbers, right, on their marginal effective or their marginal average and effective tax rate, you can see it starts going down the effective tax rate. So in this case, right, as income increases, 75, 170, 300, with regard to the effective tax rate, this column, it gets smaller and smaller. For this reason, it's considered, with regard to the effective tax rate in this specific scenario, a regressive tax.